Tyler, I've got Tyler here from Gradient Investments. I'm Jason with French Capital Management. I've been getting a lot of questions lately about concerns in the market where we're trying to combine safety of things like CDs and high yield savings accounts and be able to get the returns of the S&P 500 from 2024. So, how do you accomplish those two goals? That's it's there's an adage out there that says you can't have your cake and eat it too, but we can get you as close as we can. So we're going to talk about the buffered index portfolio. And Tyler here up at Gradient Investments, he's going to give us a deep dive into the portfolio and how it works, and then we will have some questions at the end. So Tyler, I will turn it over to you, sir.
Perfect. Thanks for having me, Jason, as always. Um, but yeah, so really, I just want to start out high level with the methodology, the objective, execution. So when we're talking about the buffered index portfolio, the objective of it is really to give you some type of market exposure, whether that's to the S&P 500, Dow Jones, NASDAQ, Russell 2000, all of the what we call major indexes here in the US. And so, broadening this out, we can pick and choose which indexes we want. We typically stick with the S&P 500 or Dow Jones, but the objective is to give you some type of market exposure with the idea that you're going to get some level of protection. Now, the one that we're going to talk about today is 100% principal protection, but there's others out there that we can choose from, whether it's 20%, 15%, 10% protection, depending on how aggressive or how conservative we want to be with the offerings. So the idea, again, the objective, market exposure with some level of predetermined downside protection. And we're doing this through what we call structured notes that have defined maturities. And we'll kind of get into really what those are. We don't want to go too deep in the weeds today, but certainly try to give you a higher level understanding of what structured notes are, and how they operate, really, and why we have this portfolio. So a structured note, it's really issued by a U.S. bank. We call them financial institutions. So when we're talking about risk of these notes, I just want to start out by saying that really all we need to understand is that you have a contract with a specific financial institution. And so the risk of this is the credit of the underwriter, meaning credit of the bank, which is why we've chosen to always work with investment grade banks, banks that many of you probably have heard of, whether it's JP Morgan, Goldman Sachs, BMO, RBC, major banks. Bank of America is another one that I can throw out there, but major banks that many of us have heard of. And so that's why, as far as making sure that we're as safe as possible when we're using these, we want to make sure that we're using the best of the best banks that are out there. So again, structured note issued by a financial institution. The returns are linked to the specific asset or index that we talked about, whether it's the S&P 500, Dow Jones, NASDAQ, Russell 2000. Again, we try to keep the bigger indexes, more well-known indexes are the ones that we're going to use rather than trying to find a niche market. We certainly can, because the space is so big that we can do that, but because we want to make sure that everybody has a way to track it, or understands what we're tracking or linking to, we want to make sure we're using the major indexes here in the US. So again, the S&P 500 and Dow Jones are probably the most popular ones that we use. There is a fixed maturity date. Just like a bond has a fixed maturity date, so do these. So typically they'll be 12 months, 18 months, 24 months. We always try to make sure that they're more than 1 year, so that when these mature, if there is a gain at the end, hopefully there is a gain at the end, it's taxed at a long-term capital gains if you're in what we call a non-qualified account. Obviously, if it's a retirement account, that's not as much of a worry. But if there is a non-qualified account, we want to make sure that these are taxed at long-term taxable gains rates rather than short-term. So if we ever do a year, it'll be 366 days rather than 365. The thing about these is they're not actively traded on public exchanges. So you can't just go out and buy these. we go directly to these underwriters to structure these. And there's really nowhere that you can go you can't go on Schwab or Fidelity and just buy one of these notes. They're not actively traded on the exchanges. But why invest in these? And I think the number one reason is you get benefit from the index's upside, right? Jason, you were talking about having your cake and eat it too. This is where you can get that, right? You get some level of protection. Now we'll talk about the specific one here in a second, but you get some level of protection while participating in the upside of the index that you're tracking, right? And having that protection built in is something that obviously helps people sleep at night. So you get the benefit of the index's upside while providing you the downside protection, depending on the levels, whether it's 20%, 10%, 100%, some level of downside protection. And we'll call it shorter time horizons, right? It's not locking anybody's money up for 5, 7, 10 years. Like I said earlier, it's 12 months, 18 months, 24 months is typically the longest time period that we'll go out and have these as maturity dates. So just really quick, some general terminology, just so everybody's on the same page here. Market exposure. When we talk about market exposure, it's the return that is based on the price return of the specific index, not total return, but the price return. So when the S&P 500 has a dividend yield of 1.5%, so if the S&P 500 price return is 10%, the total return is 11.5%. The market exposure that you would get would be the 10% return, the price return of the index. The buffer is just the predetermined level of downside protection. The buffer is the predetermined level of downside protection. The cap is the maximum level of return that you can get. Participation rate, it's how much are you participating with the index. So if you have 100% participation rate, it just means that you get 1-for-1 return of the index up to the cap. If you have 105% participation rate, it means you get 105% of the index's return. The outcome period is just the maturity time frame. So, whether it's 12 months, 18 months, 24 months. So some points that we think are important to really consider here is these do have the fixed maturity date. These are designed to be held point to point. Now, if we all know that things come up, you may need cash for something. Yeah. The nice thing about these is, even though they're not readily tradable on an exchange, these are still liquid. We want you to hold these point to point because that's when you get the full outcome of the terms that are predetermined. But should you need to get some money out of this, it is liquid to do so. We just go back directly to the underwriter. They buy the structure back from us or from you out of your account, and you'll have cash within a day or two to be transferred out of your Schwab account. So it's designed to be held point to point, but knowing that these are still liquid and not locking you up for 12, 18, 24 months completely out of your money. So we encourage you to stay invested in these because the intra-pricing, this is where the point of this comes, is the intra-period pricing. So, you're 6 months into the note and the market is up, call it 12%. You may not be fully up 12%, right? In order to realize that full effect of the terms, you have to be invested till the end. So structured notes can lose money, right? We're going to talk about a specific one here that has 100% principal protection, but even these can still lose money. And I'll talk about how. But buffer notes, they offer a predetermined level of downside protection. It could be 10%, 20%, 100%. And so if the market goes down more than 10%, or the index that you're tracking goes down more than 10%, that's when you can start to lose money. If you have 100% buffer, meaning you have 100% principal protection, you're hoping that the bank doesn't go bankrupt, right? And so that is why we work with the best of the best banks, the biggest of the big banks as well, to hopefully ensure that doesn't happen. So It can lose money, just as a side note there. But hopefully we don't have any of those issues, especially when we're talking about 100% principal protection. We're investing in, the credit rating of the bank. And like I said, we want to make sure that we're working with the biggest and the best banks that are out there. And that is exactly what we do. So at maturity of the note, the account goes to cash. So if you have a gain and it's in a non-qualified account, in a taxable account, it'll be taxed at long-term taxable rates if obviously held to maturity. If you sell intra-period, after 6 months, you sell a portion out, you'd be taxed at short-term tax rates. But here's the one thing that I want to note, because we are going to be talking about the 100% principal protection. With these notes, they can be subject to ordinary income tax intra-period. So similar to, I don't want to go too far in the weeds here, but there's something called a zero coupon bond, where it's the actual cost basis of the bond steps up every year, and you get taxed on that step up in cost basis, even though you may not have gotten any income out of it. That's the same concept with these, because the IRS deems these as similar to a zero coupon bond. Because you have 100% principal protection, the cost basis of these after 1 year or at the end of the year will step up slightly. And so you could have a small tax that would be at short-term income tax rates for the intra period. It should all kind of wind together at maturity. But just know that there will be a small step up in your cost basis for holding these intra-period, because you have the 100% principal protection, and a small portion of that will be taxed at ordinary income tax rates. So here is the specific note that we were talking about. This is the example. So cap, meaning the upside participation, the predetermined level of maximum return you can earn is the cap. The current offering is 13.9%. The buffer, meaning the protection that you have on your principal, is 100%. The participation rate, meaning if the market or index goes up 10%, do you get 1-for-1 on that? And you do, with 100% principal participation. And the outcome period, the maturity time frame is 18 months. So in that scenario, in 18 months, if the market is down 20%, you get your principal back, because you have 100% principal protection. So your return would be 0, even if the index is down 20%. Same thing for down 5%, you get 100% of your principal back, meaning your return is 0%, even though the index is down 5. Same thing for down 1, you get 100% of your principal back. If the market or index that we're tracking is up 5%, because you have a cap of 13.9%, you get the full 5% return of the index that you're tracking. If that same index at the end of the note is up 20%, you are up 13.9%, right? Because we have a cap of 13.9%. So if the market goes above and beyond what your cap is, you get capped out effectively. So in order to get the 100% principal protection, we have to give something up, right? We can't have both sides where we get 100% principal protection and full participation of the market. If the index goes up 100%, we just can't get 100%, right? We have to give something up to get the protections put in place. And so that's what the cap is that 13.9. If the market's up 20, you give up some of that upside to make sure that you have the principal protection on the downside. So caps, there's a lot of things that go into making the cap higher or lower. So number one is the index used. The higher the volatility or higher price fluctuations of the index, the higher the cap will be. So different indexes can get different levels of upside participation. Again, volatility of the index, higher volatility, meaning higher price fluctuations, more frequent price fluctuations can lead to higher caps. Higher interest rates can lead to higher caps. So if interest rates, a 10-year U.S. Treasury yield is about 4.5% right now, if that goes to 5%, we could get higher caps on these 100% principal protected buffered index notes. If interest rates go down, cap levels can come down as well. Dividend yields can affect it. So if you're using the NASDAQ versus a high dividend paying stock index, that can vary the caps. Maturity length, so the longer the maturity, the higher the caps. And then offering size, the more money that we have investors put into it, can also lead to having higher caps as well. So there's a lot of things that affect the caps, but again, the other thing that we don't have on here is the level of downside protection that you have. So if you had a 20% downside protection, you could get a higher cap, higher than 13.9%. If you had a 10% buffer level of protection, you could get an even higher cap than having a 20% buffer. So the less buffer you have, the more upside that you could get. So just really quick before we get to the Q&A, so buffered index series, again, it offers that downside protection that's predetermined. The one that we're talking about today is 100%. The nice thing about these is you're not giving away all of the upside, right? You're participating up to a certain level, which is the cap. There's defined maturity dates, so whether it's 18 months, 24 months, 12 months, the one we're talking about today is 18 months. And then you get the price return of a specific index. So structured notes are built for a point-to-point. We want to make sure that this is money that you won't need for 18 months, right? And if you do, there is liquidity available, but the idea here is that we're holding this note for the full 18 months. It's backed by the financial institution. And again, I've said this a couple of times, and I'll keep harping on it because it's very important to us that we always work with the best financial institutions out there, JP Morgan's, Bank of America's, Citigroups, BMOs, RBCs, highest credit rated banks that are out there. And these may be taxed at long-term gains if held to maturity, if it's in a taxable non-qualified account. So with that, Jason, is there any other questions that you have for me?
Yeah, absolutely. And I'm advocating for some folks who might be interested in this, some questions that I've gotten before. Now, one of the biggest ones I've heard from my more savvier folk out there is, that sounds exactly like an annuity. But this is not an annuity contract. And
Nope.
one of the biggest differences, like you said, it's liquid. Your money, like with annuities, most of the time you're locked up for a 7-year surrender period. That's pretty common. They've got a few where you can pull it out quicker, but this is where your money is designed to be from point to point, like you said. But they can get their money back if they so choose.
Yeah, and I'll actually talk about that really quick because it brings up a good point. So, annuities, you've got fees, 10% penalties on withdrawals. I don't want to go into that. I'm not an expert in that area. With this, there is a small fee to trade out of it. So if you needed the money and you needed to sell, you could sell this on day one, right? If you buy the note, all of a sudden you're like, oh shoot, I really do need that money. We can sell out of it day one. The fee for that is, so we use units being $1,000 per unit. So when you buy a note, you buy 25 units, that's $25,000. So for every $1,000, every unit that you sell is a $1 fee. So it's $1 per $1,000 with a minimum of $10, meaning $10,000 being sold, up to a maximum of $250, meaning $250,000 being sold. But if you had a client that was like, I want to put $500,000 into these, and 6 months in they needed to take that $500,000 out, it would still be a $250 fee, right? So it's $1 per unit up to a maximum of $250. So there is a trading fee with this. It's not something that we charge. It's something that Schwab and the underwriters charge to basically take these notes back.
Gotcha. And so, there's and so Schwab is the platform that we're doing the construction of the portfolio with. This other I mean, you're a CFA, so good on you for being able to get to that level right there. I don't think most people, when they see that designation, have any idea the amount of work and effort that gets put into it. But you've got, you're the portfolio manager for this. You've got an entire team that you're working with, right?
Yeah, yeah. I mean, so, and we also don't structure these in house either, right? We don't have as much as the CFA is the gold standard in portfolio management and buying stocks, selling stocks, options trading, right? I'm not necessarily an expert in structuring these types of products, right? There's a lot of internal options that are what I would call exotic options that go into making these, that I don't think many people have heard of. And they're the internals of the actual options package that comprise this structured note are very complicated, right? And it's something that we decided when we were going to launch this portfolio, we decided that we didn't want to take this on. We wanted to make sure that, again, we're working with the best of the best credit rated banks, number one, but then number two, some of the best options teams that are out there to structure these, right? So we have a team of 5 CFAs on staff. We manage a lot of different portfolios. I feel, we know what we're doing when we're managing these portfolios. But as far as going in depth on this type of portfolio, we felt it was better to work with somebody else outside of our walls to structure these.
Gotcha. And another thing you're talking about is there's when we talk about loss, for example, there is there's the performance of the underlying assets that are asset class that's in there, but there's also the credit ratings for the banks, and how what exactly do you do to evaluate which banks that you want to work with? How are you, what's the criteria for saying, yes, we want to work with this bank?
Yep. So Moody's and Fitch and Standard & Poor's are the 3 major credit rating agencies that are out there. And they're constantly updating their ratings on all of these banks and quite frankly, most public companies that are out there. So we're constantly monitoring those reports that come out to make sure that, JP Morgan doesn't slip from a single A rated investment grade company to a triple B or even a double B, right? We're constantly looking at that. The rating agencies will also come out with opinions on do they think the credit rating of these companies are steady or not. So we'll keep an eye on that and read up on the reports that those companies are putting out there. So we're trying to make sure that we're as conservative as we can. Now, there's plenty of banks that are out there that are, could still be investment grade, but they're a lot smaller as well that we could deal with. But when we think about any sort of crisis, we want to make sure that we're with the biggest financial institutions as well, because they're well funded. Credit rating is obviously a priority. So the likelihood of these banks going under is very, very slim, right? You can't guarantee in our business. So, but I would say it's a very slim chance that these companies would go under. And the other thing too is if we start to see that credit rating deteriorate, because this is still considered one of our portfolios, we can take action in selling these notes ahead of time before they start to lose value. So a good example of that is when Credit Suisse was starting to go under, and their credit rating really didn't change, but the stock price was reflecting some type of issue with the bank. So what we did was, instead of holding on to these notes and waiting for Credit Suisse to fully consider bankruptcy and sell their entire business to UBS, we were able to sell those notes ahead of time to make sure that our clients did not lose money, right? So that's an option that we still have as well. If we start to see these banks deteriorate, we can take action ahead of time.
And the terms buffered index portfolio and dual directional portfolio, they, even though they're structured notes, that's a term that's been around for a long time. But in terms of popularity, you didn't really hear too much about these even 10 years ago. What was the spark in the finance industry for the industry to come together and say, "Hey, this is what people want"? What was going on?
Well, so one thing with Gradient is we're Gradient Investments is big enough where, you know, we get ideas from these big underwriters or companies that we're specifically working with. And so, we actually had a BMO approach us about, potentially offering some of these notes back in 2019. And we're always looking to make sure that we have a diversified set of portfolios for clients. And so when they brought this to us, the question that we asked ourselves is, would clients use these, right? And I think the overwhelming answer is to have some level of downside protection while participating on the upside. If you look at the market and you say the market's average, call it 10% per year, and you can get a return profile of basically more than that average while giving someone 10 or 20 or 100% protection, that's a pretty good product to offer, right? And so knowing who our end consumer base is, typically, you can't lump everybody into this, but typically it's near or in retirement, right? And so how do we help them sleep at night, or how do we have an offering that or portfolio that helps them sleep at night? And that's where this stepped in, right? We can offer some level of protection. We're not going into double levered Tesla with some protections, right? We're using well-known indexes that most people know as well. So it's easy to track. You can go on CNBC and see what the S&P 500 is doing over the last year, and you can probably get a general sense of where your note could end up, right? So we wanted to make sure that we had that diversified set of offering for our end clients, also knowing that it's something that they can, track at the end of the day as well.
Okay. And then also, I think it's important to note that this isn't a typical portfolio that you can get in your 401k at work. I remember you mentioned that because it's a closed-end fund, right?
So it's not even a closed-end fund. So if you if you open up an account on Schwab, you can go and buy mutual funds, closed-end funds, ETFs, individual stocks, individual bonds. But the way that these are structured, you can't, because I don't want to go too deep into the weeds here, but the way the underwriters have to structure these is so the structure is basically the bank issues a zero coupon bond at whatever interest rates there are, uses that leftover. So, the bond trades at a discount of, let's say, $960 out of $1,000. They use that $40 to go build an options package, and they build that up front, right? So they need to have a source of funding to do that. There's just not a open-ended way for them to do this. And so for us, it's nice because, these are proprietary to us, right? You can't go and find this specific note at a different company, right? These are specific to the offerings that we have. And the other thing that I didn't mention is that we work with 11 of these different underwriters or financial institutions. And every month we go to them and we say, what are your best offerings with these specific parameters? And they all know that they're competing with each other. So they're trying to give us their best offerings they possibly can, because they also know that we're a big enough size. Yeah, and we're big enough size in these. We probably do about 50 to 60 million a month in these, and so we're big enough recurring business for them that they want to give us the best offers they possibly can. So that's the other part of it, is you can't find these elsewhere. They're specific to us, and they're probably, I would say, some of the best terms that you could get out there.
Okay. Tyler, thank you. That's very informative. And I want to. I'm sure there's going to be more questions as I get them from some other people out there. So thank you very much for doing this video and the the presentation slides. And for everyone listening, this is once again Gradient Investments, and so this is Tyler Ellegard. Is that how you pronounce it?
Ellegard, yep.
Ellegard, okay, Ellegard. And so he's a portfolio manager for the Buffered Index portfolio, and Mike Binger, he's the CEO of the company. You'll see him a lot on Fox Business. Send me a DM, leave some comments in the comments section, and send me your questions. And if you think this might be a good fit for you, please contact me and let's talk more about it. That's all for everything. And Tyler, thank you very much.
Yeah, absolutely, Jason. Thanks for having me on.